Hello everyone and welcome to the channel of Sigma Plus Industrial Solutions. In that video, we will continue our discussions about cost savings, and we will focus our discussions on the cost savings that could be generated by reducing the level of the inventories or the percentage of the inventory out of the annual sales. But first of all, let's understand what's the meaning of the inventory. So a simple definition of the inventory refers to all the goods and the items, the merchandise and the materials which used to be held by the business for selling in the market and earning profit. The inventory covers not only the final products which are planned to be delivered to the customers, but also cover the raw materials and the work in progress that's still existing in the production floor. So since that we have understood now the meaning of the inventory, we need to understand what is the meaning of the inventory management. So in fact, there is a very nice and simple definition for the inventory management, which is having the right inventory at the right time and the right place. And we can also say that a good inventory management creates a good synchronization control between the time of ordering the materials and the time that it is needed in the manufacturing, which is by turn building a very strong financial health for the organization by generating more cash flow that will enhance the capability of the factory to buy and purchase the other required materials. In fact, we have three main categories of inventory cost. The first one, which is known to be the holding and the carrying cost. The second one, which is known to be the ordering cost. And the third one is the shortage or the stock out costs. And this is what we are going to discuss in details in the next slides. So starting with the carrying cost or the holding and the carrying cost, those are all the costs associated to manage a storage facility or warehouse that contain the materials. And we can divide it in three categories: the storage cost, the capital cost, and the obsolescence cost. The obsolescence cost is known to be all the materials that had been considered as date out or expired, or even the cost of the damaged materials that had been occupied in a warehouse for a certain long time in the warehouses. We have also the capital cost, and the capital cost is known to be the interest lost due to keeping the materials for a long time in the warehouses. We will again discuss in details in the next slides. And we have also the storage cost, which include the related cost to the rental fees of the warehouses, the electricity bills, the labor cost, the servers, the tools and equipment that are used to fix some racks or machines in the warehouses, plus the insurance cost related to the value of the materials that it is stored in the warehouses. So starting with the storage cost, it's the amount of the money incurred as a result of storing the inventory. And this cost could be direct or indirect money spent on the storage of the goods. The storage cost may include cost for space, rent, electricity, software, depreciation, and warehouse personnel. Okay, so let's have an example to better understand how can we calculate the storage cost. So to have a storage cost estimation, suppose that you're managing a 1,000 square meter warehouses and you're paying monthly fees as per the shown table. So you're paying a monthly rental of $12,000. The monthly electricity bill is $1,750. The monthly labor cost is $10,000. The monthly insurance cost is $500. The monthly cost of utilities service is $500. The monthly cost of the tools and equipment is $1,350. Okay, so the total monthly storage cost is $26,100. So if I just want to know how much it will be the cost of the storage per square meter, it will be simply by dividing the total monthly storage cost by the total area of the warehouses. And that's from where we got the 26.1. Then we add the tax percentage, considering if the tax percentage is 32%. So that means that each 1 square meter will cost a storage of $34.5. Okay, so if we want to estimate the cost of the goods that will occupy a storage area of 150 square meters for about 3 months, so simply I will multiply the 150 square meters with the 34.5 for 3 months, which will be equal to $15,525. Okay, so we have understood now how to calculate the storage cost, but what about the capital cost? And the capital cost, as we have explained in the first slide, it is in as simple as is the interest lost of that the value of the materials that is kept in the warehouses. So as we know that the value of the money is decreasing by the time, so keeping the materials for a long time in the warehouses will lead to lose the interest of the bank. So for as an example, if we take for the same warehouses, the last example that we took, the company spent 90 days, okay, to transform the raw material to a finished good or a finished product. And this is what we know with the inventory turnover. To sell an amount of inventory of $1.75 million. So the total value of the materials was $1.75 million. Considering that the annual interest rate is 5%, calculate the finance cost for keeping the materials in the warehouses for 3 months. So by dividing this value by 365 days, we get the lost money value per each day, which is the 0.0137, almost 1.01%. Is the lost value of the materials per day, okay, due to holding the materials and keep the materials stored in the warehouses. So if I want to calculate the wasted money for keeping the materials that have a value of $1.75 million for 90 days, then simply we will multiply the 1.75 with 0.01% multiplied with the 90 days, it will be equal to 21.5 KUSD or $21,500. Okay. What about now the third category of the cost associated with the inventory management, which is the obsolescence cost? And the obsolescence cost, as we mentioned earlier, are the costs related to the damages that could be occurred for the materials, which could be kept for a long time. And it's quite possible that those materials could be subjected for any accidents or during the transportation time that led for any certain damages, right? Or also some materials could be outdated, means that they have a certain expiry date, so they are not anymore useful for the production, right? This type of inventory has to be written down or written off and can cause large losses for the companies in case that they have been used by mistake in the production. The obsolescence cost represents the monetary value of damaged products or outdated products that cannot be used anymore. Some companies might use a percentage of 6 to 12% for the risk of obsolescent materials. So, considering that the total value of the obsolete materials for the last 3 months was $135,000, if we refer to the same example that we were speaking a few minutes ago, we can summarize the total value of holding and carrying the cost of an inventory by the shown table. So we have calculated earlier the storage cost was $15,525, and the capital cost was found to be $21,577, and the obsolescence cost, which we have found from the damaged materials or expired materials in the warehouses, we have found to be $135,000, with a total holding and carrying cost of $172,000. Okay, it's good always to describe the data in a pie chart so we can see the percentage distribution of the holding and carrying cost, where we can see the obsolescence cost in that example is representing 78% out of the total cost related to the holding and the carrying of the materials. So I have been speaking now about the first category of the cost associated with the inventory management, right? But let's speak now about the second category of the cost related to inventory management, which is the ordering cost. Okay, so in fact, the ordering cost are all the costs associated with creating a purchase order that will lead to buy certain materials and receiving in the warehouses. This ordering cost can include shipping fees, unexpected transportation cost, inspection fees, and other expenses. It can also cover the cost associated with the selection and qualification of the suppliers. For the first time, when you select a supplier for your company, you need to make sure that the suppliers will be competent financial-wise and quality-wise to produce the materials required and deliver it on time and on quality. And that needs some exercises from the SCM team to search for the good suppliers and select and qualify the supplier that the company will deal with him for a certain period. The cost of inspection the goods before receiving in the warehouses. So indeed, you need to make a quality inspection plan to verify the quality of the goods before that it enters to the warehouses. Okay, the cost of negotiation with the suppliers. This needs time and needs negotiation skills from the SCM team. And also the cost of issuing an invoice and submitting payment to the suppliers. This requires time to review all the details of the technical terms and the delivery terms. And also the cost of the quality auditing to follow up with the suppliers. These costs are irrelevant to the size of the order. So whatever is including in the order, it doesn't matter, but it is directly correlated with the high frequency of ordering the materials. So as much as you are ordering the materials, as much as the associated cost will be increased. So the shown table is an example of calculating the cost of ordering a unit material. So the cost of reviewing and creating the purchase requisitions, as an example, would consume about 4 hours. And if we know that the hourly rate is $19 per hour, so the cost will be $76 for one person. The cost for selecting and qualifying the suppliers will consume approximately 24 hours. And the hourly rate is $19. 2 persons will be responsible to do that. So the total cost will be $912. The cost of negotiations will consume 4 hours, and the hourly rate is 21. So the total cost would be 84, and so on. So we are calculating, estimating the time for the activities associated with ordering the material, and then we transfer it to the monetary value, so we can calculate the total sum of the ordering cost, which is found to be $1,314. Okay, so now we can speak about the third category of the inventory management, which is known to be the shortage or the stockout cost. And those are the costs associated with the consequence of having an unavailable materials during its urgent need in the production. Okay, and Those are the stock out costs include the loss of income and customer due to a shortage inventory from a stock out. Some economical consequential when we're running out of the stock, loss of revenue opportunities and loss of profits because you might be stopped in the production for several days that will eat your capacity and you won't be able to achieve the monthly sales targets. Losing the market share and the customers might go to the competitors because you were not able to deliver on time. Additional cost with the suppliers, and which is known to be the expedite fees, and the expedite fees are representing the cost of like the express deliveries, for example, like DHL or any deliveries that could be considered as express delivery to faster the delivery and try to recover the situation to try to catch back the on-time plan. And also there could be some additional cost in the manufacturing by opening overtime hours. So we try to cover the slippage that happened in the last days due to the missing materials. Some other additional cost could be generated to retain the customers and to retain his loyalty to the company by providing some additional services or doing some kind of discounts in certain spares of materials, which is of course leading to have an overcost running. Okay, so if we refer to the same example, suppose that the company has a monthly production capacity of 30 units. Each unit product has a revenue value of $100,000 and an EBIT or a profit of 7%. The factory reported in 3 months the actual produced units as per the shown table. So in months of January, we produced actually 12 out of 20. So we had a slippage of 8 units. In months of February, we had a slippage of 2 units. And in months of March, we have a slippage of 11 units, and we have produced 39 units out of 60. Okay, so with a slippage of 21 units to be produced. So if we want to calculate the cost stock out that caused the slippage in the revenues and the loss in profit, we will say that the slippage from having the slippage of the revenue and the EBIT. So in months of January, we reported $800,000 slippage in revenue, which generated a $56,000 loss in the EBIT. In February, we had a loss of $200,000 in revenue, which generated a loss of $14,000 in the EBIT. And in months of March, we had a loss in the revenue of $1,100,000, which generated a loss in the profit of $77,000. Okay, so as a total loss, we had reported a loss in revenue of $2.1 million, and the slippage in the EBIT was $147,000. So now if we want to know the total sum of the lost cost, the cost of the inventory management, okay, so we can see that we had reported a loss of $172,000 due to the holding and the carrying cost. And then we have a cost of the ordering, which cost about $1,314. And then we have the loss of the opportunities, which was $147,000. Maybe I need to correct myself when I spoke about the total holding and carrying cost. It's not representing the lost cost, it is the $172,000, okay? But this is considered as a lost in the revenue, in the profit, which is $147,000. So I can say that the total inventory management cost is the total sum of the holding, carrying cost, the ordering cost, and the shortage or stock out cost, which is $320,400. Okay, so what can we learn from here? Okay, if we want to generate savings from the inventory, then we can be more smarter in managing the storage area of our materials, implementing the just-in-time delivery, synchronizing the time of ordering the materials with the production, so we don't keep the materials for longer time in the production flow or in the warehouses, so we reduce the percentage of the obsolescence materials, right? And we improve the cash flow of the company by reducing the solidification. I mean, what do I mean with the solidification? Means that when you transfer your money into materials, this is considered as blocked money, right? So this is not good that those blocked money is kept in the company for a longer time. So we need to be more smarter in our capacity management, right, to deliver on time and on quality, of course, and we need to make sure that we don't miss any of the important materials. See, one of the good examples that I want to highlight is some of the SEM managers, sometimes they believe that they can get a good reduction in the cost of the materials if they buy a certain bulky quantity of materials in a certain time. But please remember that this amount of discount, the value of the discount that you will get, if the delivery term of those materials are not synchronized with the planned delivery of the factory, then what you have generated as a saving in SEM will not be seen, because the loss in the revenue and the profit will be much higher than the reduction of the cost of the materials that you got from one of your suppliers. Okay, so I thank you for your good listening and watching. See you for the next lesson. Thank you so much.